Well, it's a pretty crazy day as markets gap down in the red, and we talked about another 1 to possibly 2% move in the S&P 500 on last night's live stream. We gapped beyond that, but I want to talk through exactly what's going on. Now, by the way, if you're new to the channel, welcome into Compounding Capital. My name is Colton. On this channel, we work on fundamental analysis and long-term price action, but in this video specifically, I want to talk about what's going on in the broader markets. We've seen the Nikkei really take a nosedive, and what I want to break down is exactly what's going on. We're watching volatility within currencies, which is now driving the markets down. What is this a signal of? This means that a lot of people were over leveraged. We're able to do a lot of different things with the click of a finger nowadays that we couldn't do prior to, and this is causing markets to get a little bit more frothy and a little bit more overpriced as everybody has optionality now when it comes to investing, whether you're buying zero-dated option calls or you're leveraging with a ton of margin. And that's exactly what took place here. The US has one of the higher interest rates out there right now. So that means if you borrow US dollars, you're going to pay a higher fee. What people are doing right now is they're borrowing foreign currencies, whether it's China, but mainly the Nikkei. You can basically borrow the Nikkei at 0%, take those borrowings, and then buy United States stocks. But the recent volatility now and the sell-off has caused people to panic and sell their positions, and that's why we're seeing a huge shift in the market. So on a day like today, it's best to kind of ignore what's going on. Don't freak out. I do think we will see a relief rally back to about 52.20 on the S&P 500. Actually, let's pull up the chart here. And so I do want to make it clear that we are forming a head and shoulders pattern here, and I still believe that the right shoulder is going to be formulating, but we're oversold on the short-term charts, and it looks like a lot of buying pressure is coming in as we see this green bar right here. And in last night's live stream, I pointed out this trend line here, and this is about where I think we're going to close and start retesting back up here. Now, if we don't close above this trend line, then this could be a pain of resistance here, and this is the 180-day moving average as well. So we broke down below the 180-day moving average, and we also broke down a pretty key support level here. We actually gapped down below it, and now the buying pressure is sending it towards that resistance band, and that's about where I think we're going to probably hang out for a little while. As I stated before, I think it's going to be choppy, but I want to talk through a few strategies here. Now, if you want to avoid the volatility and buy something that pays a monthly dividend, I'd actually look at something like JEPI, where it doesn't have a lot of downside and it doesn't have a tremendous amount of upside. It's just going to trade sideways, and you're going to get between a 5 to 6% dividend based on the call volume. And with the volatility, the option volume should actually be priced pretty nice, where the income on this strategy with that volatility could actually be a little bit better than the 5 and 6% that they've recently been paying. So this is one I definitely would use, because when we look at the October lows, you're looking right around $50 a share. When we look at the all-time high and all-time low, the all-time high was $63. The all-time low is $50. It's currently trading around $55. I think anything below 54 makes a lot of sense if you're concerned about volatility and wanting to be somewhere where you can consistently get a dividend and not have a tremendous amount of price action. This might be a good area to hide for a little while on this volatility. The other strategy I really like in this type of market is, instead of just buying into positions, I would actually be using cash secured puts. And so let's take a look at some of the premiums and some of the ideas that I would be using here. So when we take a look at Intel's chart here, it's bouncing exactly off of where I said it would bounce, guys, last night on the live stream. I said right around that $19 mark. If we get a break below 20, if this thing starts hitting $18, $19, definitely becomes an interesting stock, in my opinion, from a risk versus reward. I could have bought the stock today for $19.29. But what I can do now, instead of doing that, is I can write a cash secured put. So I come to the option thread, and let's say that I'm willing to go, call it 2 weeks out. So let's say I'm willing to go to August 23rd, and I'm willing to buy the stock for $19, meaning that if the stock is at $19 or below, I'm going to get filled at $19. But I'm able to collect anywhere between a 62 to 66 cent premium on this move. And so if we think about this from a percentage standpoint, Intel basically needs to fall another 4 to 5% for me to get filled. Plus I'm collecting $65 in premium because it's 65 cents, but you have to multiply that in batches of 100. So if I were to buy one contract, I would collect $65. Now the caveat is I have to put $1,900 aside and wait during that 2 weeks. But if we divide that $65 by $1,900, I'm basically able to collect 3.4% in just around 2 weeks. And the nice thing is I'm buying the stock at a 5% discount if it does get filled. And so because Intel is extremely volatile right now, you can actually get some pretty juicy premium buying on cash secured puts for Intel. So this is a strategy to build into positions when it's really, really volatile. As always, guys, appreciate your time. Thank you so much for spending it with me, and we'll see you in the next one.